10 of the best stocks to buy for 2023. The year 2022 was a lousy one for the stock market. Even after factoring in dividends, the S&P 500 fell 19.4% in those 12 months, while the tech-heavy Nasdaq Composite took a 33.1% haircut. The catalysts behind Wall Street's sell-off are all too familiar. Inflation, soaring interest rates, persistent recession fears, and the Russia-Ukraine war snowballed into an avalanche of worries that investors couldn't ignore. And many previously high-flying stocks took a beating as the risk-off mindset came to dominate markets. While no one can predict the future with certainty, certain stocks have caught the attention of analysts and experts, showcasing strong fundamentals and promising growth prospects. If you're looking to position yourself for success in the year ahead, we've curated a list of 10 of the best stocks to buy for 2023 and beyond that deserve your attention. From innovative technology companies driving the digital revolution to healthcare disruptors at the forefront of medical advancements, these stocks represent dynamic sectors poised for growth. Whether you're a seasoned investor seeking to diversify your portfolio or a newcomer looking for promising investment opportunities, this carefully curated list will serve as your guide to potential winners in 2023. So buckle up and get ready to explore these 10 hand-picked stocks that have the potential to shape the investment landscape and unlock new avenues of wealth creation in the coming year. But before we move on with the video, support the channel by liking this video and subscribing to this channel for future updates. Number 10. Apple. First up is Apple, the largest publicly traded company in the world, if you exclude government-backed behemoths such as oil giant Saudi Aramco. Like other tech stocks, AAPL shares had a rough go of it in 2022, as recession fears and soaring interest rates spooked investors in the sector. Following a rare 26.4% pullback in 2022, Apple shares surged 49.7% in the first half of 2023, recently hitting all-time highs and eclipsing the $3 trillion mark for the first time in history. The iPhone maker now trades at around 32 times earnings, reflecting the market's confidence in the company's strong competitive moat. Apple recently unveiled its newest product, a virtual reality headset dubbed the Apple Vision Pro, which will retail for $3,499. While that price tag will likely make it a niche product in the early days, investors are hoping some iteration of the technology will emerge as a new source of meaningful revenue alongside product lines like the Apple Watch and the Mac. Number 9. Dutch Bros. Dutch Bros, a small coffee chain, experienced a 48.4% revenue growth in 2022, with 716 locations across 14 states. The company's small drive-through stores allowed for faster expansion, with 133 new stores opened in 2022, resulting in a 25% location growth. Despite a strong start in 2023, shares fell in early May due to a disappointing quarterly earnings report. Despite this, Dutch Bros' small footprint and location growth make it a promising option for investors seeking stability in their portfolios. Shares are up less than 1% this year through June 30. Number 8. Citigroup. Next up is Citigroup, a roughly $90 billion multinational bank with both retail and investment banking arms. What Citigroup offers investors is twofold. First, it pays a healthy 4.4% dividend yield, which is a nice buffer for shareholders in an era of rising rates and high inflation. Importantly, that dividend is sustainable over time, with Citigroup using less than 30% of earnings to finance its payouts. Aside from its high dividend, Citigroup also looks like a value stock at current levels, trading for less than 8 times forward earnings and just 0.48 times book value. Famed investor and financial guru Warren Buffett began buying Citigroup stock in the first quarter of 2022, and Berkshire Hathaway now owns a roughly $2.6 billion stake in the company. Citigroup stock is up 3.9% in 2023 through June 30. Number 7. Amazon.com. Amazon, a dominant internet retailer, was named one of the top 10 stocks to buy for 2023. Despite a poor 2022, Amazon's cloud services arm, Amazon Web Services, generated over $85 billion in annual revenue. The company's valuation of $1.3 trillion, which includes its massive operations, is worth $280 billion. Despite the challenges, Amazon's cloud services arm remains a valuable asset, with shares up 55.2% through June 30. Number 6. Walt Disney. One of the most important things to consider when selecting stocks to buy and hold for the long term is a company's management team. And with the recent return of longtime CEO Bob Iger, Disney has that in spades. Considered one of the best CEOs this side of the millennium, Iger presided over a series of wildly successful acquisitions, including Pixar, Marvel Entertainment, and Lucasfilm, before passing the CEO role to Bob Chapek in February 2020. Disney's May earnings report saw the House of Mouse meeting expectations for both earnings and revenue. A recent price hike for streaming service Disney Plus helped soften the blow of a huge loss in subscribers, largely from its India platform Hotstar. This stock is up 2.8% this year through June 30. Number 5. PayPal Holdings. PayPal, a well-known financial stock, is trading for less than its 2020 pandemic lows, despite a $4.13 earnings per share in 2022. The stock experienced a 62% drop in 2022 due to a weak macro environment and the loss of its relationship with eBay. Despite a 5-year average ratio of 35.5, PayPal now trades for about 13.5 times expected 2023 earnings. Applying this conservative multiple to expected earnings of $4.94, PayPal's price could reach $100.28 per share by early 2024, a 50% increase from its June 30 close of $66.73. Recent deals with Apple Pay and Amazon also provide PayPal exposure to Amazon's online marketplace, and the stock is down 6.3% in 2023 through June 30. Number 4. EOG Resources. A return pick from last year's best stocks to buy list, EOG is a U.S. oil and gas producer coming off a successful 2022, in which shares posted a total return of 56.3%. Shares nonetheless are still priced like a value stock, trading for less than 10 times forward earnings. Growth will likely decelerate in 2023. The red-hot energy market is unlikely to skyrocket as it did in the inflation and war-plagued year of 2022. But investors shouldn't forget the value of an inflation hedge in their portfolios. A 3% dividend yield and impressively low payout ratio of less than 20% give EOG some credibility with income investors as well. As inflation concerns ebbed in the first half of 2023, EOG shares have lost ground. The stock has a year-to-date loss of 9.7% through June 30. Number 3. Grupo Aeroportuario del Sureste. ASR, a mid-cap Latin American airport operator with an $8.6 billion market capitalization, was a return pick in 2022, posting a 17% return in a bear market. The stock's growth in passenger traffic, including 3.2% year-over-year growth in Mexico and Puerto Rico, offsets a 14.2% decrease in Colombia. Airport operators generate revenue from gate rentals, landing fees, parking, ground transportation, retail, and advertising. The stock pays a trailing dividend of 2%, and shares have posted a total return of 21.6% in 2023 through June 30. Number 2. Taiwan Semiconductor Manufacturing. Taiwan Semiconductor Manufacturing, a $530 billion business and the dominant high-level foundry for advanced chips, is next on the list. In the semiconductor industry, foundries are companies that manufacture chips for other companies, and TSM enjoys a massive market share for chips 7 nanometers and under. Apple, which has started to shift its supply chain away from China, is one of TSM's biggest customers. While the company reported mild gains in revenue and net profit in the first quarter, those numbers were down 18.7% and 30% from Q4 2022, respectively. Still, the stock is trading at less than 20 times forward earnings and paying a 1.8% dividend, and TSM shares have been crushing it in early 2023, posting gains of 36.8% through June 30. Number 1. Diageo plc. Last up is Diageo, the nearly $100 billion UK-based beverage giant. A consumer defensive stock, Diageo should be able to hold up in a strained macro environment, as alcohol tends to be relatively recession-resistant. As with tobacco, alcohol consumers tend to have a fair degree of brand loyalty, and the company's slate of elite brands gives it enviable positioning in its space, with bar staples such as Johnnie Walker, Guinness, Tanqueray, Don Julio, Smirnoff, Bailey's, Ciroc, and Bud Light all under its umbrella. Despite net sales jumping 21.4% in fiscal 2022, the stock fell with the broader market last year, losing 17.4%. That's largely due to its base in the UK and a bad year for the British pound. That slump can't last forever, and shares now trade for about 19 times forward earnings, a discount to its 5-year average forward price to earnings of 24.4. As of the first quarter, Diageo is also part of Berkshire Hathaway's portfolio, with Buffett buying up about $40 million in DO stock in the first quarter of 2023. Shares of the defensive stock have slipped by 1.8% through June 30. That's it from this video. Let us know what you think about this video in the comment section below. If you enjoy this video, please like it and also subscribe to our channel. Thank you.